Disney just reported their Q2 earnings report, beat on EPS estimates, small miss on revenue. At the time of making this video, stock is down around 6% or so. Year to date, as you can see, stock has performed quite well, up over 25%, plus it has a forward PE of 23.6 times for a company that is expected to grow EPS 25% year over year. That's quite good. And then if you look at the estimates for fiscal year 25 and 26, you're still seeing some bottom line growth that is above double digits, sales growth of around 4% or so. This is of course the first earnings report after the proxy battle, so they definitely wanted to show that they're on the right track. There were some things that were a bit weak-ish, but all the rest pretty solid results. Now, before digging a bit deeper, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start off here with the key points. So as a result of the outperformance in the second quarter, their new full year adjusted EPS growth target is now 25%, which is basically meeting the expectations. They remain on track to generate approximately $14 billion of cash provided by operations and over $8 billion of free cash flow this fiscal year. This will help them with the dividend and the share buybacks. They repurchased $1 billion worth of shares in the second quarter and look forward to continue to return capital to shareholders. The big thing here is the entertainment DTC direct-to-consumer business that was profitable in the second quarter, while they are expecting softer entertainment DTC results in Q3 to be driven by Disney Plus and Hotstar. They continue to expect their combined streaming business to be profitable in the fourth quarter and to be a meaningful future growth driver for the company, with further improvements in profitability in fiscal 2025. A comment here by Bob Iger. So our results were driven in large part by our experience segment, not surprised, as well as our streaming business. Importantly, entertainment streaming was profitable for the quarter, and they remain on track to achieve profitability in their combined streaming business in Q4. Looking at our company as a whole, it's clear that the turnaround and growth initiatives we set in motion last year have continued to yield positive results, and of course they're benefiting from the layoffs as well. We have a number of highly anticipated theatrical releases arriving over the next few months. Our television shows are resonating with audience and critics alike. I mean, Shogun is probably one of the best TV shows I've seen in a while. Plus, I do believe that Deadpool and Wolverine is going to be quite a big hit for them. ESPN continues to break ratings records as we further its evolution into the preeminent digital sports platform. And we are turbocharging growth in our experiences business with a number of near and long-term strategic investments. And so, if we look at the highlight numbers here, revenue increased 1% year over year. Total segment operating income increased 17% year over year. Diluted EPS negative 1 cent, but if you exclude certain items, that increased 30% year over year to $1.21. Free cash flow increased 21% year over year, and cash provided by operations up 13% year over year. Looking at the different revenue segments, so entertainment decreased 5%, sports increased 2%, experiences still extremely strong for them, up 10% year over year. With regards to operating income, entertainment had the huge jump here, 72% improvement year over year. Sports declined 2% year over year, and experiences up 12% year over year, still by far the largest chunk of income. And so looking at entertainment, where did they take a hit? Not surprised either. Linear networks is down 8% year over year. Content sales, licensing and others down 40% year over year. That's for revenues. For operating income, linear network down 22% year over year. Direct to consumer, as you can see, is positive for this quarter, just a tiny bit, 47 million, but it's just a sign of them showing us, look, this can be a profitable side of our business, and this is the first sign. Moving on, looking at the subscribers. So Disney Plus domestic US and Canada, that increased 17% year over year. Internationally decreased 2%. So overall Disney Plus core increased 6% year over year. With regards to Disney Plus Hotstar, that decreased 6% year over year. We know that Disney Plus Hotstar is not really that monetizable for them. So a decrease there is not such a big deal. As for Hulu, SVOD only increased 2% year over year. Live TV plus SVOD decreased 2%, so overall Hulu is up 1%. With regards to average monthly revenue per paid subscriber, domestically, US and Canada, that decreased 2%, but internationally, that increased 13%. So overall, Disney Core, the average monthly revenue per paid subscriber is up 6%. And as I said before, Disney Plus Hotstar, as you can see, only 70 cents, and that's down 45% year over year. With regards to Hulu, SVOD only and Live TV, SVOD only is down 4% year over year, Live TV plus SVOD up 1%, and of course that's an extremely lucrative business. Then with regards to the sports segment, revenue for ESPN domestically increased 4% year over year, internationally weakness there, so that's down 7%. With regards to operating income, domestically it's down 9%, internationally basically flat year on year. With regards to paid subscribers for ESPN Plus, we've got some numbers here. So paid subscribers decreased 2% year over year, but average monthly revenue per paid subscriber is up 3% year over year. They say here that the increase was due to increases in retail pricing and higher advertising revenue. As for the experiences segment, revenue domestically is up 7%, internationally continues to outperform, up 29% year over year. Even operating income, the same story there. Internationally, that's up 87% year over year. Of course, not as profitable as domestically. That increased 6% year over year, and that comes in at $1.6 billion compared to just $292 million internationally. Now, I do want to share some comments from the earnings call. So with regards to ESPN, Bob Iger said that ESPN will remain on linear. ESPN confident or optimistic we will end up with NBA deal long term. Disney plans to reduce Marvel output in TV series and movies, but they still feel great about the slate from Marvel. So that's, I guess, a positive thing. They also see sports basically continuing to shine in a world where there is more choice. They are seeing some evidence of moderation from post-COVID travel. That's all the comments I have right now with regards to the earnings call. Overall, pretty solid quarter by Disney. Of course, there's still a lot of work to do for that company to get back on track, back to the highs. Of course, they have to regain some confidence from the viewers, from the consumers, because let's face it, the content, whether you agree with them politically or not, the content itself, the writing, the storytelling wasn't great at all. And it shows in the numbers, in the box office numbers. Now, right now, as you can see right here, the stock has dropped actually a bit more. It's now at $107, which of course is a bit now in no man's land. The 20-day moving average is at $113, the 51 at $112, and the 201 at $101. Now, whether or not we are going to get there, I don't know, but on the daily here, we are now back at where we were after the last earnings report. So there is that big gap up from 3 months ago. So overall, that's about it. Do share your thoughts and comments on this quarter down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.